Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate filings. Today we are diving into Terra Income Fund 6's latest quarterly report. It might sound dull, but trust me, there's a plot twist involving debt, real estate, and a parent company pulling the strings. But before we start, if you find value in understanding where your money is going, make sure you are subscribed and check out our Discord where we discuss the ins and outs of the world of corporate finance. Link is in the description below. Ready for the summary? Terra Income Fund 6 is having a bit of an identity crisis. Income is down, expenses are also down, and losses continue. Plus there is some money shuffling with its parent company that we need to examine. It's like a real estate soap opera, so let's jump in. Terra Income Fund 6, it's a company that invests in real estate related debt. Think of them as a bank that specializes in lending money to real estate projects. This Form 10Q is basically their report card for the first 3 months of 2025, telling investors how well they did. Let's begin by looking at the balance sheet, like a financial snapshot of what the company owns and owes. First off, cash and cash equivalents. Think of it as readily available money went up by over $1 million to $41 million. That's good. More money for them to use. Soans held for investment acquired through participation. The loan portfolio, which is their business of making money, shows that loans held for investment, they are down almost $1 million. The company also took loans through participation. Those are also down almost $1 million. Both of those loans decreasing isn't great for overall business health. Their investments in other companies or equity interest went down a little bit too. This means that some of the companies they invested in maybe didn't do as well this quarter. Moving to what they owe, unsecured notes payable or debt, that also went up about $300,000. While not a lot, it isn't really ideal either. Let's move on to the statement of operations. This is what you would also call an income statement. And the first 3 months of 2025 aren't looking too hot. Their main moneymaker interest income is down by almost $300,000. That is almost 15% year over year. What's interesting is that asset management and services fees paid to Terra REIT, which is its parent company, also went down a lot too, almost 50%. What is going on here? Is the parent company trying to make the subsidiary look bad? We will have to keep looking. They are expecting fewer losses compared to last year. That is good, but again, why is everything down? Their loss from equity interest or investments in other companies, it decreased significantly, meaning that losses are down over $300K. Interest expense stayed pretty much the same. But get this, there is no more term loan expense. Last year there was around $500,000. Why? Because they paid it off. It seems like something good is happening here. So overall the net loss is better by around $800K. Okay, so how is the actual cash doing? It will tell us where they are actually getting the money and where it is going. Starting with net loss, they lost $2.3 million in the first 3 months of this year. Ouch! Adjusting for the fact that they are expecting some debt that won't get paid, roughly $770,000 is added back since it's an accounting estimate. That unconsolidated investment they had losses in, it gets added back because in reality there was no cash flowing there. Then it's time to look at the flow of money. There were payments on loans from customers, it was zero. Last year it was 21 million. Then new loans were almost 800K. They also funneled a lot of cash to this promissory note receivable, around 3.5 million. But hey, this promissory note also got paid back a good chunk to 5.1 million. Finally, they got some money by getting into an obligation under participation agreement, which is roughly 700K. At the end, they had over $1 million cash increase. That's how they can pay their bills. All right, let's talk about the loan portfolio. They have 1 loan at a fixed rate and 2 loans at a floating rate, and all the loans are preferred equity investments, which is basically a loan secured by a stake in a company that gives the lender more rights than normal shareholders. What I am noticing is that the loans aren't that long term. They are all basically due within months, which is a good thing for them because they don't have to wait too long to get the money back. But the rate on all of them is high, almost 20%. You would be hard pressed to find someone who wants to borrow money with that interest. They decrease the amount of loans where they are expecting issues in collecting, so that is good. So what are the chances for them to actually get repaid at this high rate? It looks like everything is non-performing and there are provisions for credit losses. Yikes. Now it's time to talk about the equity interest in unconsolidated investments, so the money they have tied up in other people's companies. The majority of this, almost all of it, is related to this SF Dallas Industrial LLC, of which they own 80%. Combined, this group of companies holds over $100 million of real estate and $80 million in liabilities. It's not clear if they are profitable or not because the 3-month figures show a net loss of around 1.7 million. Not good. Fair value measurement is where they estimate the worth of their assets, especially the hard to value stuff. The available for sale debt securities are valued at almost $500,000. That is their fair value, what they think that they can get from it. Most of what the company has isn't measured at fair value, but at what the company originally paid for it. Their unsecured notes payable debt that they own is trading at 96 cents on the dollar. Investors don't want that debt. But when it comes to their real estate loans, it's basically an educated guess. They look at things like market yields, borrowers' ability to pay, and the value of the property backing the loan and estimate their fair value. Time to talk about the elephants in the room, the transactions with affiliated companies. First of all, they loaned over $40 million to their parent company, Terra through a promissory note. I wonder if it gets paid back. They are reimbursing the parent a lot of fees for salaries, admin, whatever, and also they are paying them asset management fees. And as we saw before, these fees are decreasing due to decreasing net value. How convenient. Then we have even more transferring. It looks like another entity that is affiliated with the REIT manager got an amazing deal on this transfer. If I were a shareholder, I would scream at this deal. Finally, there are few commitments and contingencies. We saw some contracts that the company has with some indemnity clauses, but the company is not expecting to pay anything for that. Now, looking at these results more broadly, Terra Income Fund 6 is in a tough spot. The connection with the parent Terra REIT is too strong, and I suspect value is being extracted from this fund into the pockets of its parent at the expense of investors. With most of their loans being bad and high interest rates, I don't expect any meaningful recovery here. The investment strategy here appears overly aggressive and doesn't seem sustainable. Ultimately, this situation demands close monitoring. Alright, that's our breakdown of Terra Income Fund 6's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out our Discord channel for live discussion. Link is in the description. Thanks for watching. See you next time.